Hello, agents. Hello, everyone. June is Annuity Awareness Month, and here's my conversation with Gary Mettler regarding the Stretch IRA being alive and well. Enjoy. Hello, agents. Hello, everyone. Back again here with Gary Mettler. We had a good response to our last conversation regarding the lost language of immediate annuities. And Gary today is going to touch on something many of us might not have a good handle on with the new Secure Act and everything. This is the Stretch IRA and the new IRS take on it and how they've go ahead and clarified the Stretch IRA. And I'll just tell you, Gary's done an enormous amount of research on this. And there's other videos out there and everything. And I think if you combine all that stuff together, especially what Gary's about to tell us, you're gonna have a pretty good understanding on how to use these and how they can benefit you as an agent and an agency and everything else. So, hey, Gary, welcome.
Well, thank you very much, Jeff. Yes. So, there's a lot of nonsense floating around out there regarding the death of the Stretch IRA, right? This is, headline news. It's been out there for quite a while. And pretty much it's been pushed out there by investment advisors, financial planners, mutual fund companies, even some attorneys have pushes. And frankly, Jeff, it's really frightening people. It's a bunch of nonsense because what happens is you have basically two industries here, right? So you have the savings and investment account industry that does IRAs, right? And then you also have the insurance industry that does IRAs. Two different sets of rules. And there have always been two separate rules, but people aren't just that aware of the rules associated with the insurance industry. They know the rules pretty much in the investment advisory industry and the savings account, but not the insurance industry. So these rules have existed since 1974. They're not new. I didn't discover anything new. They've been around forever. And what happened was that when IRAs first came out, well, the banks jumped all over them, right? Yes. Commercial banks and savings loans. I mean, if you remember savings and loans, when there were savings and loans, they were all over this, right? Come to our account, open up an IRA, and we'll be the custodian. We'll open an account for you. And then eventually, what happened? You had the stockbrokers and you had the mutual funds. All these companies saying, "Well, just come open it. We'll custodians, come open accounts." So they were saying, open up your IRA account with us and we'll do this, right? So that problem was there's no such thing as an IRA account. It doesn't exist. It's just a made up term the banks and the securities brokers used to market to get customers to come in, right?
Yeah, so open up.
There's no such thing as that, right? So what happened was originally the life insurance industry had lobbied, for the IRA, right? So they were included because the life insurance industry, they're not custodians, right? We don't open accounts. We issue contracts and we're not custodians, we're issuers. So what IRA really stands for is individual retirement arrangement. That's what IRA is. The arrangement is for the insurance industry. But the savings account industry investment stole that term. They put their own word in there. So they substituted, arrangement for account. And that's how they marketed it. It was brilliant. It was one of those brilliant marketing moves. And now we're stuck with it because all these decades have gone by. So we ask people what an IRA is. They say, well, an IRA is an individual retirement account.
Exactly. Yeah.
No one says it's an individual retirement arrangement. But when you look at the regs, it's plain individual retirement arrangement, right? And that was basically for the benefit of the insurance industry. So that's why they had that term. So, and again, because that happened, kind of all the rules associated with IRAs arrangements got lost, right? They just, the investment accounts and investment accounts and took over. And that's what everyone did, they just kind of took over and that's how assets grew. And the insurance industry was left out, in the cold, holding a bag of coal, basically. They kind of lost that war. They let that go by them without challenging it. I mean, they could have called it individual retirement apes and monkeys, and the IRS would have been okay with that because the IRS doesn't really regulate what it's called. They just regulate what it does. And so I don't know if it actually would have been tolerated or not. But I mean, they really could have called it anything. And I don't think the IRS would have objected to it. So they haven't objected now. So they've obviously let individual retirement account wording slide. So that's where we're at this point. So what happened is you had these rules, and eventually in the 80s, right, and 90s, when IRAs became larger, because people contributed, they may have rolled over 401ks, and then you had this massive IRA market start to develop, right? 80s, 90s, and today it's huge. It's just, I don't know how big it is, but it's probably trillions of dollars in IRAs. It's big now.
Yeah.
But about the 80s and 90s, people are going to think about taking money out, right? Because I'm going to retire now. I've got these account balances. And so that's kind of how the stretch IRA was born. It was birthed out of that. Well, I'm going to take money out, and maybe I don't need all my money. Maybe I want to leave some money in my account for the benefit of my my children. I don't need all the. I'm wealthy. I've got a lot of assets, and I don't really need this. I'll just pass it along. So the IRS has had these rules where you just make a withdrawal in the account, and then if there's anything in the account, first of all, you assume that to withdraw from, and then if there's anything remains in the account, assuming that, the child then can elect these withdrawal privileges. But there was another set of rules that were just for annuity contracts that people didn't know, right? And so, but they didn't stop the industry. We were back in the 80s and 90s, we were issuing annuity contracts. And we're talking about now, again, this is going to be talking about periodic payment contracts, not any annuity. So this whole video is going to be done based upon periodic payment annuity contracts, which is affectionately known as immediate annuities, right? And why are they immediate annuities? Because they're priced immediately, right? So you go back to the first video and check out that whole thing. But they're priced immediately, it's set, that's the deal. That's why they're immediate annuities. So we're talking about those kinds of contracts in this whole video. That's what we're pertaining to. So all these rules existed. And what happened was that later on in the 80s and 90s, what happened, people discovered something. They said, well, if I'm 80 years old and I got to make a $5,000 withdrawal, and my whole intention is to pass this money on to my kids, well, I mean, that's okay. But yet there's this other option, which wasn't widely known. Maybe I can go buy, I can still pass the money on to my kids. Maybe I'll go buy a periodic payment contract. And because the rules were a little bit more loosey-goosey before in 2006, they just say, well, if that's your intention, we'll just smash that RMD down to atoms, right? So maybe the savings account was producing $5,000 a year, but annuity was only saying, well, your payment's only $1,000, but they're both RMD compliant. And that was possible because the way the annuity contract was set up was to lower the payment as much as possible so that the money could be thrown back in the contract for the benefit of the kids, right?
So it's a lower payment up front, but longer.
Yeah. So the whole idea is to pass this money on to the kids. But if you're the owner, well, do I pay tax on $5,000 and maybe pass something, or do I pay tax on $1,000 and pass this tremendous deferred benefit? This kind of stuff went on. So you'd have agents, maybe your annual payment was only $500 a year. So, and they say, well, the RMD table for savings investment contracts is $5,000. But I go buy this kind of contract and only take $500 out. It was still okay, right? So this went on really, and the IRS eventually deemed it as an abuse.
Is that where they came in and put the life expectancy maximums and the maximums?
No. What happened was they finally caught on to this, right? But it took them a long time. I mean, so what ended up happening is that they said, okay, well, we're not going to outlaw it. And they could have said no more of this. They're just going to regulate it. So, and we'll still permit you to these kinds of direct payment contracts. We're going to permit it, but you got limits now. I mean, this is ridiculous. No one's paying any taxes. It's all being shoved off to your kids. And, this is ridiculous. And that's not going to happen. But they didn't do it away altogether. And again, it gets back to my first video, is that these contracts, again, we're talking about periodic payment contracts, not deferred annuities, not variable annuities, not FIA indexed annuities, nothing that kind of stuff. These are all periodic payment contracts. And why do they have special rules? And we talked about this in the first video. They have special rules because they protect society. They're there to keep you from going broke. We talked about that the first time. So that's why they got all these special rules, and people just aren't really aware of it. So, and this is why they have a stretch IRA exemption, because they just, they protect society better, right? So they said, what we'll do is you can still do it, but after 2006, you have to issue contracts. We issue contracts in such a way that you've got to bring the payments up. You just can't atomize these payments and roll this money back into the contract. So after 2006, insurance company said, okay, we'll follow the rules. We'll issue under these guidelines. And that was fine. That went on. There were thousands and thousands of periodic payment annuity contracts issued between 2006 and later on into 2020, right? I mean, it was no question. I mean, that was just the rule. We would follow the rules, and that was the rule. Now, there were a lot more savings accounts and investments issued. I mean, because the periodic payment annuity market is pretty small relative to the savings market, right? So no one, and that's the problem, is that people don't really pay attention to it. Nobody knows what's going on in there, because it's not even the favored son of the life insurance industry itself. They want agents to sell deferred contracts, these FIAs and VAs, and those are just savings accounts, and they have to follow, those contracts have to follow the savings investment account rules, but not the periodic payment contract. Those are different contracts. You see, they have special rules because the IRS likes them.
Yes.
So what happened? So what happened is it commanded more moderation in what you can do. In fact, one of my jobs at Presidential Life was to make sure we didn't violate the RMD rules, because we were, like you said before, Presidential Life was issuing hundreds of millions of dollars. We issued, like I said, 60% of our premium was in periodic payment annuity contracts.
Yeah.
We were like a star. We issued a lot of qualified business, because that's what people have the money, isn't it? Qualified money, not necessarily non-qualified. So, we issued a lot of these things. So part of my job was to make sure we didn't issue an incorrect contract, because we issued a contract and the payment was too small. Well, guess what? Now you've got an under distribution happening, right?
Yes.
And it's a permanent contract. And that might not have been caught for years.
Yeah.
So what's the penalty for an under distribution contract? 50% of the amount you should have taken, right? Plus all the interest and penalties associated with the under distribution. So if you didn't catch it for 5 years later, who's going to pay that penalty? I mean, theoretically, the consumer's going to pay it, but because of the way the contracts are set up, there's no way a consumer could judge when they get the contract. It's just impossible, because the rules are so convoluted. There's no way you could judge. A consumer can't judge if the contract is compliant or not. They rely on the company to say. So the company actually probably would have, we would have been responsible. We would have had to pay the penalties probably. And there's no way we got into a legal issue. There's really no way we'd get out of that. We're the only one, the carrier is the only one who knows. The consumer will never know. Even the agent won't even know,
Yeah.
So it's really on the carrier's shoulders to make sure they don't, screw this up. And that was part of my job. So this went on forever, right? And then things changed. And then it went on till when? It went on to the Secure Act, right?
Yeah.
So that was in 2020. So that just threw a whole, and that threw a whole thing, even the savings investment accounts, they were all messed up also, because they had limitations not put on them. And so that was the big attention. Oh my God, we can't do these saving investment account stretch IRAs anymore, because the Secure Act is here. They've changed how we can make distributions.
But the 10-year maximum.
Right. That was the big rule, right?
That's the big rule. 10 years
slide,
money. And then the people didn't even understand. Does it have to be all out in 10 years? Or do you have to take it systematically over 10 years? So that was even confusing for people.
Yeah. So that was a problem. And and it's really depressing to think about it. We had people at the IRS who wrote the Secure Act. They just, they weren't really that. The average person probably wasn't really that bright who actually wrote the Secure Act. Because what they forget? They forgot about the periodic payment. And not only the periodic payment, because the periodic payment contracts is also the pension industry, defined benefit pension industry, and the periodic payment contracts have the same rules.
Yeah. Because
defined benefit pensions work exactly like periodic payment contracts. So they're all regulated separately, right? So the average person was really depressed. If you think the average person IRS is just something less than bright. And
well, remember, the SPIA is an orphan child, a forgotten language.
Yeah, but the defined benefit pension industry is huge. I mean, people make pension elections every single day, you know,
yes.
and they had a fit. But so I always say, well, if you think the average person, the IRS is maybe not that bright, it's depressing because you think, well, if the average person is that bright, I mean, mathematically, that means 50% or something less than that.
Yeah. And they're handling, and they're setting up the laws.
George Carlin line, by the way. Anyway, so it was silent. The Secure Act didn't even mention it was completely silent. No one knew. And this went on from 2020. So everything kind of
assumed it was. Everyone assumed it was included in the SPIA.
Well, yeah, no one knew because IRS didn't mention it. No one really knew.
The insurance companies changed their software to limit any qualified money.
Yeah, so that just happened recently, which is such a big shocker because they got to change back.
Yep, it took them a year to do it. Yeah. It took them forever.
It's so bad.
But now the ones that didn't bother doing it, they're the ones that are okay.
They're the stars right now. Yeah. Well, you shouldn't have listened to me. I was bitching about that all the time. You know. Yeah. What do I know? You know. So anyway, so that now some have done the change, and nothing to change back now. But in any case, so the Secure Act was exempt. Came out. I mean, not exempt. The Secure Act came out, and no one really knew. And it was just kind of threw a really a big pall over the life insurance industry for these contracts, direct payment contracts, and also the pension industry. But who complained the loudest? It wasn't the life insurance industry, it's the pension industry. The pension industry had a flying fit about this, and they placed pressure. I don't know what the life insurance industry was doing. For as I know, I don't think they even knew what was going on. Half of them, they were oblivious. They're all attention.
I think they were worried about existing payouts and stuff.
Yeah, I mean, but existing payouts were grandfathered by the Secure anyway. But what happened was they had continued issuing. You see, after they didn't change how they were issued; they kept doing it. So they had these contracts were issued after the Secure Act that they might have been probably out of compliance, and that was a whole big problem with them, right? And so there's probably fairly speaking, there's probably some concern there on their part. I don't know, but I know that pension industry, because I knew a lot of pension people, defined benefit, because we're all in the same kind of thing, right? Pensions and immediate annuities, periodic payment annuities is all the same thing, regulated the same way for RMD issues, right? And so they were like pitchforks and nooses with the IRS, right? So eventually, what happened? 2 years later, 2 years, Jeff, they come out with the Federal Register, 2/24, 2022. It's 2 years later, almost a little bit longer than 2 years. Finally clarifying, not only did they clarify the savings investment account rules, because there were some issues there, they made some clarifications there. But then they went back and they said, well, they have a whole section. Okay, so we left this out. Here it is. This is how it's going to work for annuity contracts. And that was very clear, But the problem is, this is the problem. Now, that's a 76-page document, right?
But the clarification?
Yeah. I mean, the whole Federal Register that was published in is 76 pages. So the problem is that the first 35 pages, guess what that's about? That's about the investment savings account industry. Okay. About how they control their savings investment accounts for withdrawals or anything. The defined benefit annuity industry starts on page 36. So you think it through.
That's why no one found it right away.
Oh my God. You found it. It's like they could put that in the front, really?
Yeah.
I'm talking. This is the kind of respect we get, but that's not what happened. So what ended up happening was this came out, but now it had been 2 years and people had forgotten about this and this, these rules. And I went back, I've been saying, well, we were just going to restate the rules, but I realized 2 years have gone by and the knowledge was already weak to begin with, let alone stacking up a 2-year hiatus on top of it, which was even more detrimental. And so I said, you just have to be aware of now, there are two kinds of rules. And of course, this is all being played out with the investment advisors and certain, we'll say, well, it's just dead. We can't do it. Like I said earlier, come see us. We'll do Roth IRAs. We'll save you. Or you have a few attorneys will say, well, you can't do these stretches. Come see us. And we'll do specialized, trust work for you for $20,000. Attorneys defy economics, right? There's a million attorneys. No one can freaking afford one. It's unbelievable. Yep. So that's part of it. And then you also have, you have some life insurance agents who, want to solve the stretch IRA problem, by selling life insurance. And this is all just so, I'm not saying those things are not appropriate. They might be. I'm not saying they're not. I'm just saying I think that there's a lot of miscues going on because they're not telling the whole story. Obviously, anyone can do these contracts, and you don't have to be a special beneficiary, a special owner. There's no rules. They're very simple, and you can easily take care of a stretch IRA issue. You just have to play by the IRS rules, all the rules, not just the rules regarding the investment savings account industry, right? So, and I think, and I get tired of it, listening to all this headline screaming noise out there. I think people are just getting scared. I talk to people who would just say, well, I can't do a stretch IRA. It's not permitted. I said, well, that's not true. You can do one as long as we follow the rules. And this is what you're looking at. And of course, the only two vehicles exempt from the stretch IRA rules are imposed upon savings accounts are pensions, defined benefit pension plans, and IRA annuity contracts. But periodic payment contracts, not IRA savings account contracts. That's it. That's the only thing. Now, I don't really want to talk too much about pensions because we can't really affect pensions, right? That's between you and your employer. How you elect your pension benefit. That's a different matter. So basically, we'll talk about individual retirement arrangements, right? That can affect your own personal IRA, because that's what you can have choices on. And you have multiple choices. So that's about the history, kind of what happened, what transpired. And I think what I did, I decided, take a chance. I put together a PowerPoint.
Yeah, let's see that. Yeah,
I haven't really done a lot of those, but I did one. And I think it's important to me walk through a case. Like, what does this look like? Because it is different.
Definitely.
RMDs in periodic payment contracts, and a lot of people will be shocked by this. Even I think insurance agents are shocked because they don't really know this, because what they're doing. They're selling life insurance, they're selling disability insurance. They're just selling, most of them are selling deferred annuities. They're not selling periodic payment contracts, right? That's what the market's at. That's what the carriers want them to sell. The carriers want you to sell savings.
They want fee attached riders.
Yeah, that's what they want their agents. They pay them to sell those contracts handsomely, right? That's what they want.
I've seen them up to 14% totals on those.
Yeah, these are just, this is just industry, when it comes to meet annuities and periodic payment contracts, the industry might talk a good game, maybe they might, but they're really a bunch of empty suits, really. They don't get involved with this anymore. So what we're going to do is go through a real case, because I don't think anyone has even saw a real case. I've got real cases that I published in the past, but never did the video, never really people.
Well, it's good to give examples. People like the agents want examples of what they would do in everyday life and how.
Yeah, so let's take a real case of how it would work and why you'd want to use it. That and there also, like everything else with periodic payment contracts, there are other ancillary benefits, and we'll talk about some of those that don't exist with normal IRAs. That it's just the governments like these things. They got special deals going on with the law, the government. It's amazing. And I think they're under talked about because carriers don't want to do it, basically. Or they're not skilled enough. I don't know. Maybe they don't know themselves. They forgot. It's been so long. But
no, there's no demand. No one's asking either.
Yeah. They don't spend any money. They don't have any. We had our own department, right? We actually had a SPIA department. Was its own step with the executive officer. It wasn't even part of, no one has that anymore.
You guys had your own underwriting department.
Yeah, those people have been fired already. Those people have gone out of the industry already. But anyway, so let's do a screen share real fast. Okay. Okay, there we go. Okay, so here's my first little screen. Again, we're using black and white. Black and red, the Maestro color scheme, and then my little Maestro meme. Is that what you call it? A meme or I don't know what that is.
Caricature.
A little symbol, a little maestro symbol.
Yeah, it's a little character.
Yeah, I have it in the book and everything. So an annuity case example, all right? So let's look at this. Okay, so initially, this is the rule generally, because I want to make a comparison, right? This is the rule for investment savings IRAs, right? So you got investment savings IRA, right? You look at the balance of the account, right? It could be any kind, mutual fund, savings account, right? You can see how old you are in the year you make withdrawal, how old you are on December 31st, the year you make the withdrawal. You'll look at the IRS table, right? In this case, I chose an 80-year-old person. Doesn't matter your gender. Just go by the IRS doesn't matter about your gender, just your age. In this case, the table will say you got 20. This is the new table, by the way, the 2022 table. We'll say you got 20.2 years, $100,000, and now you got to take out $49.50, right there, $49.50, right? And that can go up and down. You know, if your account goes up, you take out more. If the account goes down, you take out less. If you're entirely broke because you invested in, Carvana,
Right.
you go to zero. There's nothing to take out.
Like that.
And again, as you get older, the table reduces, so you take out more. That's very common. Any investment business can tell you this. This is very common. Okay. So, and then what else do you have? Well, typically you have this beneficiary. You name a beneficiary in your account, and when you die, if there's something left in your account, the beneficiary then has access to that. They can mostly the beneficiary would just take the lump sum and that be it. That's how most beneficiaries will do it. This whole 10-year rule they have now is probably not going to be utilized. It could be, but probably, I bet you probably, 75% of the time, it's just a lump sum election because the beneficiary has to make the election, not the owner. And I think a lot of beneficiaries just want to take the money and go. They're not going to care about the taxes or this 10-year rule. That's not what they're going to do most of the time. From my experience, actually, that's from my experience.
I got the same experience.
They're going to take the money and run, babe. That's what the beneficiary is going to do most of the time. So now you got this rules that are set in for these savings account. Well, now you have the exempt beneficiaries. And I'm not going to go into about what those are. There's a whole listing of who those people can be. Because they don't affect us. Exempt beneficiaries do not affect the insurance side of a stretch IRA RMDs. There's no exemption. Anyone could be a beneficiary. Okay, so we don't need to discuss it. But again, for a savings investment account to have a little bit more longevity to it and have withdrawals possibly at the beneficiary X over a certain period of time, you have to now be an exempt beneficiary and qualify. And then maybe you can take withdrawals over 12 years or 15 years or whatever.
And you mean like a spouse or something?
Well, no, it could be someone else. I mean, there are other people besides a spouse that can do that. But a spouse is always eligible for that. I mean, spouse is not part of it, but this would be other people, like especially be like children, siblings, ex-spouses, those types of people, people that you're not married to. So in order
what makes them exempt?
Well, I mean, part of it could be if they're disabled, part of it could be just because of their age. So there are these various rules they have, but they don't affect periodic payment contracts. Okay, whatever those rules are, forget about them. They don't come into play for stretch IRAs for periodic payment annuity contracts. All right, so that's how it is basically. All right, so let's go to annuity IRA info. Okay, so we're talking about, again, periodic payment contracts, right? And those are going to be your SPIA, single premium annuity, DIA, deferred income annuity. I told in the other video, we used to call them deferred immediate annuities. We don't call them that anymore. They're called deferred income annuities for various reasons. But again, not FIAs, not MIGAs, not RIA, none of these things. These are all deferred annuities. They're all savings accounts, and they'll have to follow the previous set of rules. All of them.
So even if it has an income rider triggered,
it doesn't matter. When a death, they'll have to follow the rules laid out on this slide.
The Secure Act, yeah.
Yeah. Okay, now, so officially the IRS rules that covers periodic payment contracts and also defined benefit pension plans. So that's not 401ks or profit sharings or anything else. Defined benefit plan is basically a corporate sponsored annuity. And that's why
Yeah.
periodic payment annuities and defined benefit plans have the same RMD rules, because they're the same. Just one's offered by your employer and one could be purchased retail through an insurance company. They're exactly designed the same way. So here's the rule for 1.4019A6. That's the rule that was established, back in 2006, carrying forward. And that's the rule that's referenced in the Federal Register, published 2/24/2022. And if you read the title, they're on page 36, and the Federal Register says required minimum distributions for defined benefit plans and annuity contracts. Very clear. Okay. You can get more clear than that, right? They're telling you this is what the rules are, right? So again, we'll have a case. We'll start building a case, and you have a possible person who might be interested, right? So in this case, we have a father, right? And the father has, like I said earlier, like in the 80s, 90s, substantial assets. Maybe they've acquired this IRA balance and probably not going to be relying on it too much. Maybe the father wants to have more of this asset passed to their children. The children get other assets. They're going to have, maybe the children will be passed mutual funds, stocks, bonds, real estate, collectible. All these assets are passing to the children, right? So the idea is that he may not need or not depend upon the IRA income as much as another person might depend upon it. More modest means, and so he's not too interested in the income this thing produces. And he says, what we'll do is I'd like to pass more of this IRA to my kids or to my child, right? So, and that's the first level of interest. The second thing that comes up is that, again, what's the difference? Well, because it's done in a periodic payment contract, you now have what's called this structured payment, right? And this is actually a selling point. So what happens is that the father says, I don't think it's a good idea. My kids are getting all this money and they're getting all this wealth from me in these different forms that's going to be passed to them. And I don't know what's going to happen. How if they get in trouble? How if they lose their wealth? I don't know what's going to happen to them. All right. So I like this idea that part of the money I have, part of this IRA, and again, it doesn't have to be a whole IRA, it could be part of your IRA, is this. And the idea of having this kind of structured payment being paid to my child over the life expectancy, and this is all COLA adjusted, and we'll get into why there's a COLA on it, so that when I die, then I know they've got this money coming in. It's going to escalate. It's guaranteed by the contract to escalate over decades, and I don't have to worry about it. They won't be on the streets. They'll have some money coming in that they can depend upon if bad stuff goes down, right? So that's a selling feature, right? So another selling feature, which I want to talk about, is you have this. I touch upon it, and maybe we can do a video on this later on. But there's also a marital property issue going on here, right? So, and this is a problem when people have other types of wealth, IRAs, you name it, that pass to their kids, right? And what happens if you pass money to your kids, the money's paid to them, and then years later after your death, many years later, your kid gets a divorce. So what are the marital implications in that? All right. So, and I did a lot of divorce work. I did in 5 years in California. I worked on over 3,000 divorce cases. I was huge in the divorce business in California. Yeah. I was doing 120 cases a month in divorce.
Jeez.
And of course that all followed, like I said in my first video, that all followed the earthquake in '94. That's how I got my life back. My financial life back was I talked to you early in the other video about how I did that. I got in this business. People had just went to hell financially. It took me years. We talked about that in the first video, right? How that happened. So because of the earthquake in California, divorce rate was like unbelievable. So that's why he did so much divorce work. All this other work was financial, legal work was being done because people were just going broke basically. So anyway, yeah, what happens is there is a special aspect to these contracts, right? Because when you inherit money and you're married, or if you're single, it doesn't matter if you're married. Whatever you inherit under the law, is always going to be separate property money, right? Even if you're married and I inherit from my father, that's my money. That's not marital money, right? So, but this is what happens is that as time goes by, there's this legal theory, or what happens legally. It's called transmutation in family marital property law. So what happens is, as time goes by, what was once inherited separate property, it transmutes. It takes on marital characteristics because of what's happening with it. And as years go by, it converts from single property to marital property. Shocking, right? So what you left to your kids in the long run, way after your death, might be marital property. So let me give you an example of how this works, right? Let's say you inherit $10,000 from your father, right? Separate property. And now you're married, and I don't want to get the thing with men and women, but we'll just use a man as inheriting, because it could be the other way. It could be women too, but you could just use a man to make it easy. So the wife says, well, okay, we need a car. And, you got $10,000 to your father, and we got a few $1,000s in the checking account. We'll put that in and we'll borrow money. We'll do a joint credit. We'll qualify for a loan, and we'll buy this $25,000 car, right? So you go, okay, I'll do that. And chances are, because you had a joint, money went in and you qualified the loan on your joint credit, you're going to take ownership title of that car jointly. You're going to own it together. Let's say when you buy a house, you own it, you're joint owners, right? So now this happened. That's the initial four-way of how things start to happen. So that the next week goes by. What are you going to do? You got to put gas in it, right? Where's that gas money come from? It's marital.
Yeah.
It's marital pot. Okay. Now you got to renew your car registration. Where's that money come from? Well,
Same place.
Marital. You got to do a repair on the car. Where does that come from? Well, marital. Okay. You got to pay your automobile insurance premium. Who pays for that? Well, it comes out of your checking account, right? It's marital. So all this supporting funds for this car are being supported with marital property. Even though you got $10,000 in it separate, it's collecting marital interest. Marital is marital interest, right? So let's say now 7 years go by, your loan's done with you. Say, well, we're going to buy another car. We're going to sell the car, and we're going to take this money, put it in our checking account, and then we're going to buy another car. So you do that. You buy another car, you down payment, you borrow a loan, and then 3 years later, you get a divorce. Well, I mean, what's going to happen? You're going from the judge. You say, well, you never made any effort to separate the marital property. You never made any effort to segregate your separate property. That was done 10 years ago. And all this marital stuff has been piled into it. You buy a new car together, for God's sakes. And what happens if you're getting divorced and you claim something separate property, the burden's on you to prove it's separate. It's not the burden on the other partner to prove it's marital. If you claim separate, then you have to prove it's separate. So what ends up happening is they go, well, the judge will say, or the attorneys will, well, this is great. This is ridiculous. This is just a gift to the marriage. I mean, how are you going to prove this? So what ends up happening is this kind of property starts changing its nature, right? And what was once separate, because of transmutation and things happen, becomes marital. But
if you put it,
that can never happen with this.
Yeah.
Why is that? Because the inheritance your survivor gets on this, it's all future income. It's never paid. It's only in the future. So that can never become marital. There's nothing that marital did was to promote the future income. That was just all inheritance. So it's all separate, right? It can never become part of the marital estate. Now, the income you get from it, the monthly income, the annual income, if you spend that and you buy something together, that could be marital. But the income itself in the future that you get way after you're divorced, and now you're living separate. All that money coming in, that's all your money.
So in this instance, it was this father died. The son got the father's annuity or made it an annuity.
Yeah, the father, because the son's going to inherit.
marital.
So yeah, so we do the example here. you'll see this, and I did the grandson, so you see about the grandson. It's even a younger person, but so that's an option. So the option people should know is that when you inherit money on a periodic payment contract, that will never become marital ever. Now, if you're very wealthy and you can afford tens of thousands of dollars of legal fees, I mean, there are things that attorneys can do to, protect the separate property characteristics of inheritance, and that is available. But again, the middle class household, average households are not going to spend $20,000 for an attorney to these documents that protect separate property. That's just, I mean, people don't even do wills, for God's sakes. I mean, very few people do that. I mean, you have to have and I guess you have to significant amount of wealth probably and worry about this to hire an attorney. So these contracts are for just average people, right? They're passing on this benefit, and they know that their kids won't have to worry about a marital property claim, right? So that's one big advantage. I don't like talking about that. It doesn't get spoken about enough because I think there's enough expertise in the market to speak about it, but I do speak about it. Again, in the third payment down here, we talk about this non-lapsable, right? The son will never be able to lapse it. We talked about that's a safety issue. In the first video, we did that and talked about how this non-lapsable issue is really a protection for people, who have assets, require assets. They can't get to jam with them, and they always have this income coming in, and we kind of covered that in the first video.
Yeah,
totally. So there are lots of reasons to like this besides the tax reasons. Lots of reasons to like it. So let's go to the next slide. So here's the actual case. Let's get in the actual case. So you have 3 people for an insurance. Now this is different because in the investment savings side, you only have 2 people, right? You have the owner and the beneficiary. But for the annuity side, you've got 3 people involved. So that's a little bit new. I mean, that's something that people, it's strange to them. Like, because they don't know. They don't know how the insurance side works. They don't even know how the investment savings account side works. We have 3 people, not 2. So in this case, the case I did, you have a father who's age 80. They're the owner of the annuity, right? And they're going to nominate their grandson, who's age 18, to be the survivor, who, when the owner dies, and I get this money coming every year, every month, my money that I'm getting every month will go to my survivor, named on the contract, irrevocably named on the contract, by the way. So it's kind of like a de facto life insurance, right? And that's like the life insurance part of the pension and the IRA, is that the IRS permits this to happen because the IRS understands not everybody can buy life insurance. So they permit these arrangements if they're elected, so people can provide some kind of death benefit, for their kids. Not everyone can buy a life, especially at the age of 80. Who's buying the life insurance policy at age 80? That's it's pretty tough, So that's the reason why they have this survivorship rule, is it's a life insurance, quasi life insurance benefit. All right. So the grandson's name, the grandson in this case, in my example, is only age 18. And in addition to this purchase, because it's permitted under the IRA rules, there's going to be 20 years of guaranteed payments. Now, what does that mean? That means if the father dies and the grandson survivor dies, the proverbial happens. The father signs the application with the grandson, and they walk out of the agent's office and they get hit by a car. And that's what everyone talks about with these contracts. Well, what happens? There's a third person. There's actually a third person. So the third person is the beneficiary. Well, who is that? In this case, it's going to be the great grandson or the son of the grandson, who's, we're going to say, is 2, because the grandson's 18. So let's say it's a 2-year-old child. So the great grandson is named the beneficiary in case they both die. Then these 20 years are going to be paid out to the great grandson. So this actually has a stretch IRA. It could be over another generation. So that's the other benefit. That the savings account plans, they couldn't even offer that when they had their old rules.
You can have a contingent beneficiary below.
Yeah, I mean, you couldn't do it. I mean, it was just, that was not possible upon the death. And because what happened when the savings account rules, when the beneficiary died, it just had to be distributed. There was no third choice they could set up, So what happened was, but the insurance side there is this third person that could possibly benefit. And so on top of all this, there's also going to be a 2% compounded cost of living adjustment. So whatever payment is, it's going to start out, and every year that's paid, it's going to go up 2% every single year, guaranteed by the contract. Right? So what's going to end up happening is, if the father dies, which is probably going to happen, he's 80 years old, for God's sakes. Let's say he dies in 5 years, Jeff. And that's about what you can expect. 80-year-old will survive maybe 5 years, then die. You know, I hate to say it, but that's actuarially what you expect from this, right? So what does that mean? Well, the grandson, the survivor, is going to collect the 15 years. There's 15 years of guaranteed payments, right? Because
remaining,
right? And they're all whatever the father is getting. That's what the grandson's going to get. So he'll be paid that until he's he'll be paid that until he's 38, right?
Yes.
So that's all paid to him. So whatever the father was getting, that goes to the grandson every single year during that guaranteed period. So the grandson continues to live. So what happens after that? And this is one of the rule changes, by the way. And this is what the IRS imposed because, you know, people weren't doing this before 2006. So they thought it was abusive. But so what happens after that time, there's a table. And the IRS says, well, but this table, the father's 80, the grandson's only 18, is its table. And according to this table, 52% of the benefit has to be paid to the grandson as a required RMD requirement now, after 2006, for their life. So whatever the income payment had grown to, it adjusted to, whatever amount that was at 2% a year for 15 years, that payment's then reduced, and 52% is paid out to the grandson. Why? Because the grandson's only 38. He might live 50 years, right? And, you know, that's a long time. They got to pay this payment for a long time. So the IRS says, well, you know, you have to reduce the payment because otherwise, if you don't reduce it, which was permitted earlier, then, you know, it's even going to be even smaller. I mean, that's how you smashed the payment down, right?
Yeah.
You had these crazy survivorship rules that have now been modified. So that's what the grandson would elect to collect on that, right? So, and again, so let's look at a typical case, $100,000. The grandson's age 18, but it could be anybody, it could be an adult child, it could be a sibling, it could be an ex-spouse. It could even be a spouse, right? So everyone but the spouse is only eligible at this age difference. Again, there are 28 reductions, 28 age reductions, depending on their age differences on this table, 28 reductions. So it depends on where you fall. You just look at the table, you see what your age difference is on 12/31 of the year, and that's the reduction you have to take. But the reduction doesn't take place until after the guarantee is paid. Okay. So all these people are eligible, no special rules, no special beneficiaries. These are just the people you can name. And there you can name anyone you want to. I mean, they should have probably an insurable interest. I mean, they don't have to be. Yeah.
As long as it's not your insurance agent, I think you're okay.
Yeah, well, that's a problem. I mean, but you know, people again, but you know, the reason why people buy these other contracts too, because I mean, maybe they have someone they want to survive them that the other state beneficiaries won't be too happy about. If the owner named somebody else that they didn't know about, you know. But I look at these issues, the people's personal lives, why they buy these kinds of contracts. That's another thing we can discuss later on. Anyway, so the beneficiaries only age 2.
I've seen some interesting stuff.
Yeah, I mean, you get all this stuff. In the insurance business is rife with this stuff. So anyway, because people are just people, you know. So what does this contract produce? This contract produces under this parameters: age 80 father, 2% COLA, grandson is the survivor, the beneficiary is the great grandson. This produces the annual income. It's monthly, but I annualize it, $3,210 a year.
Okay. So
that's your annual income.
I have a question.
Okay.
Now you show this 52% to the survivor, and that's the IRS rules.
Yeah.
But how does it go from the 20-year certain? Are you built in to receive a 52% survivor?
Yeah. The contract, what happened will be the carrier will just look at, see what the next payment is, and the start of the 21st year, whatever, because that payment's going to grow 2% COLA, right? It's going to keep growing. So whatever the payment is, grows to the beginning of the 21st year, that payment is going to be reduced to.
Okay, so we're talking
50%.
life in 20.
Yeah.
Life in 20.
Joint
Okay.
life. So there's a joint life because you talk about the father and the son.
Okay.
Joint life, 20 years, period certain. Yeah.
With a
Exactly. That's what we would call it, right? I'm trying to get around that.
52% survivor. And a lot of
right.
times these survivors, if you get a good annuity contract, the survivor, if you have a joint in 20, that payment will, even if everyone dies, the payment won't reduce until after the guarantee period of 20 years.
Yeah, that's the same thing here. See, it won't reduce here.
That's what you want, but some will. But you want to make sure you buy the contract that says first 20 years are guaranteed 100%, even live or die.
Absolutely. You want, and that's what the IRS will permit. The IRS permits these contracts under this specific language. You know, they IRS specifically said reduction does not have to take place until after the guarantee period. That's part of the IRS RMD rules for these contracts. So the first 20 years or 15 or 10 years, whatever you have, that's sacred. I mean, that will never.
Yes. And the way the IRS protects that is,
right.
Can an 80-year-old really buy a joint in 20?
Well, see, now you get into issue, and we'll talk about issue and contract because because of interest rates and the IRA rules, you're going to have some. You're not going to be free or willing anymore. Okay, you're going to have to, and again, we'll talk about that in a little while. Okay. But anyway, so this is the base income you're talking about, right?
Perfect. Got it now. Yeah. So 100% joint and survivor products, and not a period certain only.
Yeah, this is exactly. So let's talk about this. So remember the first example I gave was 49.50, right?
Yes.
And you have this IRA annuity throwing up 32.10. Both RMD compliant. There's no different. They're all RMD compliant. But the annuity is a 35% difference. Because it's lower, right? So what happens to this difference? 1740. Well, that gets thrown back in the contract for the benefit of your kids. That's where that goes. Because they're getting the benefits. So this 1740 is just reflected in the benefits they're receiving over the length of time they're going to live.
Yes, and the reason we have the lower payment is because of the option we took, 100% joint with 20 and
That's right. That's right. And so that's why the IRS regulates it. So again, we're talking about three parties here. And again, limitations, how IRS regulates this is, well, we're going to regulate the survivor payment. We're going to regulate the period certain duration. Yeah. We're going to regulate the cost of survival. Well, I call it cost of survival. Cost of living adjustments. Yeah. Okay. Because what happens in the old days, you can do anything you want. And that's how you atomize. That's how you crash the payment right down to $500 a year or whatever.
10% COLA, yeah.
Yeah, 10% COLA. You have a 3-year-old kid, you do 100% benefit. I mean, this was going on. And people didn't know that because who was paying attention to what was going on in the qualified immediate annuity? Nobody. Some agents knew that. I wrote these myself when I was an agent back in the 90s, and people were shocked. They go, the owners say, my God, my payment's so low. I'm saving all this tax money. Well, the IRS said that was abusive. Well, that's just abusive. And the IRS always does that with the immediate annuities. They find out about it, years, decades later, and they change the tax benefits. That happens all the time with them. So this is what went on. And again, so the survivor can be anyone, no special deal, period certain, period. For the father, you can't exceed, called the uniform lifetime table, post 2006. That's the rule. So you can't write like a 40-year in life like you could.
No.
So that was all modified, right? A COLA can only be used. A COLA can't be used on savings accounts, withdrawals. You can't. That's for at one time you could do that at one time. And then I forget when they stopped doing that. They stopped doing that a while. I think it was in 2006 they eliminated that.
Like a CPI adjustment.
Yeah. So if you had a savings account, COLA, you're taking a withdrawal from mutual fund or something, you could have estimated a COLA, and that would have impacted the amount of withdrawal you'd have to take.
Wow, cool. And
that was very, not too many people did that. Not people didn't know that rule, but the IRS kicked that out. No.
That sounds very arbitrary.
Yeah. So that's what happened. So they were modifying. They were basically savings investment people were modifying withdrawals based upon this COLA they were using. And the IRS, that was one of the things I know when that stopped. I want to say 2006. It may have been earlier. They kicked it out. So the rule now is a COLA can only be used now on either a defined benefit pension plan or a periodic payment. It's the only way we can use a COLA now. That's very specific. And we've always issued them that way. A COLA is not available. You can't do that. You have to comply with your withdrawal for savings investment accounts by the uniform lifetime table. That you're not modifying that. That's the table you use pretty much to calculate. So again, we get these deferrals post 2006, we get some exceptions, and you could still create quite a big legacy benefit is if you have a spouse, right? And the classic there is, much older male, much younger female, right? Because for a spouse, there's no survivor percent reduction like there is for a non-spouse. They get 100%. They can't up to 100%. That's their maximum. So if there's a 25-year age difference between the husband and the spouse, and I had a couple of those, I can do 100%, and a lot of that IRA will be shifted over to the spouse. Yeah, that's still available, by the way. But again, it's only a spouse, so and they can do that for spouses, but nobody else. So
what happens if they become not a spouse, an ex-spouse?
Well, okay, that was the other thing that was in the secure. That was another thing that was questionable in the Secure Act, is they didn't talk about these annuity rules, and that did come up because what would happen if you bought an RMD, an annuity, and it was priced that way, but then you get a divorce, and that was my big thing is, well, they're not a spouse anymore, so they're not eligible. How are we going to fix that? That was always a big problem, right?
Yeah.
And so what happened is when they did the Federal Register in February of 2022, on page 65 of a 67-page document, you had to read the whole
not
thing,
an
right?
afterthought or anything.
So what the IRS said, well, we recognize this is an issue with periodic payment and pension. So what we will permit, if they get a divorce later on, through their court actions, and they can file a document with us saying that they get a divorce, and it's called a qualified, it's called a domestic relation. For an IRA, it's a domestic relations order. That's what they call it for an IRA. For a qualified plan for pension, it's called a qualified domestic relation, a QDRO. Qualified for pension plans, and IRA is just a domestic relations order. That's technically what it is. And if the court rules that spousal benefits, that you bought as a spouse and you're on the contract, it's irrevocable. You can't take them off.
All right, cool. It's grandfathered.
Yeah. So what's going to happen is the IRS is going to say, well, okay with that, even though they're no longer spouses. It was bought when you were a spouse, and that was one of the shadow. We didn't know what they're going to do with that before.
They usually land on a pretty
yeah, which is reasonable. That's reasonable because you bought it with your spouses. I mean, and it's in the pensions, like these are contracts, they're irrevocable. You can't just go back and change them, Then how would you do that? They've been priced actuarially and mortality pooled. It's nonsensical. That's when we had a problem initially with the Secure Act. They didn't talk about that. That's why it was a problem. So yeah, a long divorcing couple, they get an order from the court, and they'll be treated for RMD purposes as if they're just still a spouse. So they won't have any problem with the IRS, basically. So that's how they dealt. It made sense, right? Made sense. So now we have the IRA annuity reality. Okay, so this case I did, Jeff. Okay, these are the maximum deferrals for this case.
All right, this is the one you shop with the company. Okay.
This is the one that I found.
Okay.
How many life insurance companies are there in the United States?
Hundreds.
1,200?
There's
1,300?
hundreds. I know there's 700 just on the vital sign sheet, over 700. So yeah.
So this is a problem periodic payment contracts have, is that there aren't that many companies. You think there would be more, right? Who know what they're doing, who have any kind of interest in this. So the problem is the problem is that it's difficult to find a carrier, one carrier. This is only one carrier. I spent a lot of time with this. I could maybe spend days trying to find carriers for this case, right?
Yeah.
So who will do the maximum? So the thing is that the question is, will all insurance companies issue the benefits? No, they won't all issue.
Not at all. Yeah.
No. And why is that? Because they have their own issue guideline. I mean, just because the IRS permits a maximum issue doesn't mean the carriers will do it, because they have their own issue guidelines, right?
Yeah, they have their own file.
They have their own
contract.
pricing, and they have their own risks they're willing to take. But they're not, we're not going to take these risks. So we'll issue this, which is something less than the maximum. We're not issuing the maximum because we're just not doing that. So this is the problems you get into with the qualified contracts, is that it's not really clear who's doing what. No one keeps track of this stuff. There's no, record of this, So this is a problem. This is why it's a little difficult for the agent to kind of navigate all this stuff. Another problem you have too is it's not that they maybe not want to issue it. Okay, so then the third problem is that you just can't issue anything you want. You can't just say, well, we're going to issue this because we have this case and we'll issue it. You have to have a state approval. I mean, you just can't do anything you want to do. So there's an internal document carriers file for immediate annuities. The states, it's called an SOV, statement of variability. They file that. And on that statement of availability, list all the things they're willing to do, all the terms, conditions, all the price, everything's listed on this. And they file with the state to get approval, right? They have to have approval. If it's not on that list, they can't do it, technically. I mean, they may find some way to do it some other way, and maybe not as a new issue. I mean, there's ways that kind of, I don't want to get into
they take a deferred and make it.
That's a monkey wrench. But that, if the state finds out, I mean, probably won't, but I mean, that's not cool. But anyway, so they have these ways of the carrier's not filed, you can't get it, right? So what's the bad news? The bad news is to know that the thing to know is the maximum deferral. I mean, maybe the consumer doesn't even want the maximum deferral. They just want part of the deferral. They want more of the income. They're willing to do a deferral for their kids, but they want maybe more of the income and less of a deferral. So you don't have to always do the maximum, you can do something less, right? So that's the other thing to find out from the consumer is, well, how much of a deferral do we really want? Do you want the maximum deferral, or do you want something in between? I mean, so that's part of the discovery process the agent goes through for these kinds of contracts. But the bad news is that the carriers don't know. They don't know what the maximum deferral is. They don't issue that.
The companies that are paying, the companies that are paying attention, but the ones that aren't are saying 10 years.
So the problem is, and if you're an agent and you want the max, well, how do I do that? I mean, if they don't issue it and they won't tell me how to calculate, how do I do that? I mean, for example, what the agents use is that they use software, right? We have the software package, and you put in the information and you do it, and you know what it is, the quote systems, right? Canix has a big system. You go to Canix and you put your stuff in there and it spits out a thing. There's no toggle switch to say, toggle this, here's my case, what's the maximum deferral? That is not happening. There's no such functionality.
It may tell you if you've gone past some kind of maximums, but
but you have to guess.
Yeah,
I keep guessing and guessing. So the bad news is that it's, even if you call the home office, they have to keep running iterations, because the home office people or agent, they don't know where to start. And if you know where to start, then okay, well, I know where to start at, then I can, it's easy to go from there. But if you don't know where to begin with, then you kind of, what do I have? Is this the best I can get? I mean, maybe I get a better issue over here. Maybe this other carrier is going to, be closer to the deferral I want. But you don't know that because you don't know what the maximum is. And this is part of the problem with it. And this is why, agents probably, if they're going to do this, should talk to FSD or somebody else who might help figure out this.
Well, we got all the companies. So that's what
I
lined up running them. I know who's doing the stretches right now. I know who's cool with them. There's some actual companies actively marketing to recruit that type of import that type of business, get that type of business.
What do you mean? I mean, qualified
business? Stretch really? IRA business, non-qualified.
Wow, there you
stretch.
Go.
There's a couple out there marketing, have brochures and all that.
They're the ones on the cutting edge. See, it's not just me. So I did some articles and writing. People were saying, well, Gary Mettler, he's kind of this kook, he's the old school, he drank the Kool-Aid from the 80s and and
I don't know that they're not doing it after the fact of you, but once the stretch came in and was again allowed, they came in. It was about the same time as you, or after you, actually.
I'm not a mover and shaker in the industry. I'm just someone that's laying this stuff out. The carriers are
you're finding areas no one else is looking at because no one's interested in those areas. It's not a profitable enough area for certain insurance creators.
Yeah, and they have to have a crew that knows what they're doing, basically. That's another problem. People, like I said, people say, I just drank this Kool-Aid and I won't give up on it. I always said, well, I didn't drink the Kool-Aid. I go, I made the Kool-Aid.
Hey, are you done with the screen?
I say to people all the time,
Are you done with the screen here, Gary?
Yeah, I'm done with it. Yeah,
you can turn it off.
So that's the deal on how that works. And maybe, I don't know, Jeff, if you can share that, I can send you the PowerPoint. And
it'll be, know what, if you want to send me the PowerPoint, I'll put a link in the description to this video and they can actually download the PowerPoint.
They can see how the real case works, So they know that, it did take me a while, even me, it took me a while. I found a lot of carriers who would issue, right? But, they would only issue part of it, or part of them. They wouldn't issue every component. They just wouldn't do it. That was, either it was an age problem because the 18-year-old's too young. We're not doing it. We're only issuing the 45. We're not going to do that. They're out. Or maybe the COLA's too big. We're not doing the COLA. That's out. Or maybe they won't reduce. COLA, Some carriers don't reduce the payment in that fashion. They reduce the payment only if one dies, then they reduce it.
And no one reduces at 52%, by the way.
Yeah, that's a weird thing. Right? So how do you find that?
You don't. You could have to do 50 or 66.
Yeah. So, but you have to do the higher. You couldn't do 50 because it's too low. You'd have to do 60, and then you're sacrificing on pricing. You do 60, right? So that's what I'm saying. Or even a COLA, maybe 2% is the COLA you've come up with, but
they only offer 3.
Yeah,
most companies only have a 3. There's no you can dial in 1 to 5. There's very few.
Yeah, so maybe you do a COLA that's maybe 2.25. Who issues that?
No one.
2.5. I
think there's one company that.
There's one company will issue partial. And we did everything. We issued. So what kind of
you guys even did rated aged?
Yeah, we did underwriting, medical, but it's just that kind of flexibility in the marketplace is just. That went out, I think, with presidential life. And I don't know anyone maybe the old Safeco, they were bought up also. I don't know who owns them now, but some ones, they're gone. So I'm not sure who owned them. They were also, there were some other ones along the way, First Colony. And there were quite a few that were specialized.
First Colony was really good. I don't know.
All those carriers are gone now.
And all killed them.
All investment savings people took over the insurance industry, and that's what it's all about now. And these old kind of contracts are these special features, and
they were amazing.
They protect consumers so much better. I know, and this doesn't get talked about enough. I just really worry.
Yeah, remember Canada Life? You could dial into the deferred annuity 5 years ago with every feature in the world. The immediate annuities have regressed, not progressed, in the last 25 years.
Yeah, because they don't want to spend the money to develop them. They don't want to spend the money to train people. They want to spend the money to change your systems.
The only thing they've done to the immediate annuity is make it a savings, a lapsable product now, or some of them can have lapsable features to them now with the commutability. I like the commutability that just says, hey, you can only commute the guarantee period, and then once that's over, the lifetime starts again if you're alive.
Well, now that's the thing too, which I didn't bring up. The IRS addressed also, because you realize that's an issue, especially in the annuity market. Farther back in the reg, past page 36, there are some rules for supporting contracts, periodic payment contracts, that will permit commutability, so that people can take back some of their future payments and convert them to current sums of money.
Okay, good, yeah.
There's a rule for that, but I don't expect carriers to do that because they're having a hard time now just with normal contracts, and most of them up into that rule would not permit commutability on qualified contracts.
They're everywhere now.
Yeah, so non-qualified, you can do that, but in the qualified side, a lot of carriers wouldn't do it. They just wouldn't do qualified. But now there are some rules laid down. They're actually been very clear. If you read back in there, And I don't know if you can get that issued. I don't know if a carrier will actually issue a commutability contract with all these features with an additional right of commutabilities to some degree. But I don't think they're just up for it. I don't think they've modified their systems to really do. I don't know.
There's one or two out there. I think you'd be surprised.
You'd have to find out. You'd have to, if you had a case and that was an issue, again, if you do a commute part of the payments and your income's going to drop, you know. And because
there's all different ways to do it.
That was always a question. That was always, even the non-qualified side, that was always a problem question, because again, what's the annuity rule? Well, you have to have substantial equal payments.
Substantial equal payments based
if
on
you don't have, then it's not in the immediate annuity. That's one of the rules. So if you're going to, and people really know, because IRS has never been clear on what they mean by that. What does that mean? Substantially, what does that mean? 51%? I mean, who knows what it means? It's whatever the IRS says it is, after it's already in force, you know?
Yeah.
So people, and that's one thing I tell people in the non-qualified side is, if you want to, you know, of course you have other, of course now you have freedom. This is only, we're only talking about IRS here, where the IRS is really handcuffing you. Now, on the non-qualified side, you can do the same idea, but now you don't have all these IRS regulations that, you know, you can have a lot more flexibility.
Yeah, it's after tax money. They already got their tax.
Yeah, what you can do, the IRS doesn't care about that. So you could build a stretch non-qualified. I mean, that's very common.
Yeah.
And that's an option that some people might do if they don't have any, you know, qualified assets or a little.
It does the same thing, right? It protects the assets, it protects the heirs.
But you have a little, but you have more things you can do. The beneficiaries don't have to be a certain age. There's no special rules. I mean, you can have all kinds of pricing with that you're not restricted because it's non-qualified. So
Gary,
that is available too. Yeah,
it's all good stuff, Gary. I really think the stretch is great. I don't think it's being used. I don't get enough calls about people asking like, hey, we want to do some planning and all that. So maybe you getting it out there and these other companies, and I know certain big companies have put webinars out regarding the stretch. So maybe it'll get more into it, and
maybe I would like to know about that. I would really like to know what carriers are starting to do, because that's just a reaffirmation that they're getting back on the ball. You know, not going to be pushed around by these savings investment advisors and companies. They're coming out. You know, the insurance industry sometimes, I think, suffers from meekness. They're just, you know, I don't think they have much of a response. You know, they don't really push back on this stuff. You know, they just take whatever happens to them. They kind of, you know, go on. There's an old saying, you know, Arab saying, dogs bark, but the caravan moves on. That's an old Arabic saying. And they just kind of shrug this stuff off. And I don't see them as being, you know, pushing back, you know, but they need to push back. This whole thing, the stretch IRA is dead. That's just nonsense.
Well, they're starting to now, and I think this is going to help. We'll put it out. We're going to tag people from the companies, let them know that this video is out there now. But Gary, I'm going to wrap it up because we're going really long.
Okay. All right, Jeff.
We're probably over an hour now. So.
All right. Okay.
But good. I just want to tell everyone, if you have any questions for Gary, go ahead and I'll put a link in the description to all his information. Here's a copy of his book. You can see there. Always keep your hands up. I'll have a link to that too.
You know what? We'll do one next time. We'll do a marital property. That'll be a shocker. That would be a real shocker for people. We'll do it an hour. That'd be, people have no idea, really. I mean, you think a deferred annuity is good? Give me a break.
Hey.
This is what you want. But anyway, we'll talk about that later another time.
Sounds good.
All right.
Gary, again, thank you so much. Hey, it's Memorial Day weekend. Have a good time. And
all right, Jeff.
Enjoy your days off. And I'll go ahead and put this up. I'll put link in the description to everything. I want to thank Gary again. And let's go ahead and stop this recording.
Well, I hope you all like that. Gary Mettler in the Stretch IRA. I hope it was informative and helpful. And be sure to follow me on YouTube, LinkedIn, and all those other great places for more information. And we hope you have a great week. June is Annuity Awareness Month, so remember that. Thank you, everybody. I hope you enjoyed. Bye-bye.